How does the lender assess the state of the property? I understand they do appraisals a lot. Is that how they determine what the house is worth and what condition they're willing to lend on?
Yes, but there's two different sides of that. When you're looking at mortgages, there's high ratio mortgages and there's conventional mortgages. High ratio is anything over 80% loan to value. It has to be CMHC or insured. So our insurers in Canada are Canada Guarantee, Genworth, and CMHC. We have three. Anything over 80% loan to value has to be insured. If it's insured, the insurer, CMHC or Genworth, will actually do an appraisal on the property if they feel that there's any risk to it. Okay. So that's not a cost that's going to be incurred by the client themselves. On a conventional basis, anything less 80% or less, then the lender will require an appraisal. And with that appraisal, the client will be required to incur the fault.
For those people who doesn't understand what a loan to value is, can you please explain that?
Loan to value is the amount of the mortgage in comparison to the value of the property. So the purchase price or the current market value is what we base the number on, and then the amount of the loan that you request. So of course, subtracting the down payment.
The other thing you mentioned was credit, is that right?
Absolutely.
So can you tell me a little bit more about that? How does that affect how a lender would look at you?
Your credit needs to be, and this is a very basic guideline, your credit needs to be over 620. Now, credit scores with Equifax are on a range of 350 to 900. So anything over 600 is seen as good, anything over 680 is seen as excellent. So anything over 620, you are pretty much able to be
approved.
Pretty much able to be, I can't think of the word, insured. You're able to get financing through the A world. Okay, in the mortgage broker world, we have A lenders, B lenders, and C lenders. The A lenders are the major banks, mortgage corporations that offer the best rates and the best prepayment privileges. Then there's the B world, who are the alternative lenders. The alternative lenders look at people who have a little bit of weaker credit, perhaps they've recently gone self-employed, can't qualify on their income, softer income situations, and then the C world is the private lenders. So when we're looking at the spectrum of credit, anything over 620, you should be able to get financing in the A world. Anything less than 620, you might have to look at the alternative world. And usually only in extreme circumstances, meaning you're currently in bankruptcy or you've had foreclosures, major issues, you have to go to the C world, which is the private financing.
I see. So what can someone do to improve their credit?
The best thing to have, the ideal credit situation, is you have at least 3 credit lines. And in the bank world, we call them trade lines. So you need to have at least 3 credit lines reporting on your credit bureau at all times.
So this includes your credit card, any loans you might have on vehicle as well, right?
Absolutely.
Are there any other ones?
Lines of credit through the bank, credit cards, vehicle loans, RSP loans, personal loans of any sort, yes. Anything that would be reporting on your credit bureau from the bank side. Mortgages do not report on the credit bureau. That is something they're trying to change, so that could change at any point. But at this point, they are not on the credit bureau.
Okay. For those people with weaker credit, would you suggest that they wait to find a house and repair their credit before they go find a property?
Absolutely.
So to do that, they can get a small loan, like a line of credit, a credit card, and start using that and paying it on time, paying it full, and that will help build their credit up, right?
Yes.
How long does it usually take for their credit to be increased?
It depends on how much negative credit. You know, there's the people that are just recently getting credit. You want them to go and get a credit card and have that reporting, even if it's a $500 limit. And then 3 months later, go and get a second credit card. As I was saying, the ideal is 3 trade lines. So even if they have 2 reporting at the same time, it'll increase their credit score and their overall risk factor will be less quicker. by having 2 trade lines. If they only have one, it's going to increase very slowly. Okay. So you're looking at ideally a full year before you can qualify.
I see.
Versus if they have 2 trade lines, you might be able to push it a little bit sooner, even like 6 to 9 months.
Okay.
Being that they probably have been paying rent for the past year, ideally, so you can use alternative forms of credit to accentuate the credit, the Equifax report with lenders. If they've been paying rent, they have a cell phone bill, they have utility bills that they've been paying on time, you can use those alternative forms of credit to accentuate their credit bureau if there's nothing major, no major derogs on their credit bureau.
I see. So even if it's something as simple as getting 2 credit cards, paying $10 on one, $10 on the other, instead of $20 on one, that would help them to decrease it from a year to about 6 to 9 months. Right?
Absolutely, and the important factor in that is actually using the credit card. It doesn't help to just have the credit card. If you're never using it, it doesn't actually report on your credit bureau.
Sure.
You have to at least, I say, put a tank of gas on your credit card every single month and then pay it off. If you're going to maintain a balance on your credit card, that's okay to do as well, as long as you're not exceeding 65% of the limit.
And to always pay in at least a minimum amount at the right time.
Absolutely.
Okay.
I always say it's better to pay twice a month than it is to just pay once a month, because then you're certain that you're covering your required minimum payment.
I see. You mentioned rent as a way of reporting a credit. How would somebody go about doing that? Because normally it could be through a personal homeowner and you're renting a basement. It's not necessarily through a property management company. How can we go about finding that information to provide to your lender?
Some lenders will allow us just to use a letter from the landlord saying that their payments have been made as an A1 status for the past 12 months. Some lenders
A1 being on time payments.
Absolutely.
Okay.
And some lenders will just want 12 months worth of bank statements to show that every single rent payment came out without an NSF.
And that would be the bank statement on the applicant side.
Absolutely.
I see. Yeah, and the fourth thing you mentioned was down payment. How does that affect what the lenders see when you provide a certain amount of down payment?
The strength of the down payment is determined by its source. So somebody's savings account, obviously they've been very diligent putting the money aside to save for their down payment. The lender's going to ask for 3 months worth of bank statements to prove their down payment has been saved. They don't care what happened the prior 3 months before that, but 3 months is the key. You can use, for first-time home buyers, you can use your RSPs, you can also use your investments. Lenders will even accept, if you're not a first-time home buyer, to use your RSP, but of course there's the implication of the taxes on that that you would have to pay. But when you're looking at other sources, such as you can use gifted funds, gifted from an immediate family member, as another source. Only immediate family.
And what's the definition of immediate family? Is that parents, siblings, grandkids?
You're looking at grandparents, parents, brothers, and sisters. You're not allowed to go to extended families, such as uncles, cousins, second cousins. So gifted down payment is seen as your own resources as well, but it's obviously not as strong because you never put that money aside and were diligent with. But it is accepted. Sometimes it can be the weaker part of that leg if the rest of the application wasn't as strong. But if the rest of the application is strong and the source of down payment is gifted funds, that's completely fine. It's very common these days.
When you say weaker leg, how does that affect the lender in the whole picture?
That might be the situation where you're asking for an exception on the credit. Maybe their credit is not very strong, and then they have gifted down payment to boot. So it kind of gives you that overall things aren't as strong on that side. If the credit is just a little weak, has some small issues in the past, that might not affect the whole overall application as with having a gifted down payment. But if they've had previous bankruptcies or they've had major derogs in the past, that could be the thing that would cause the deal to be declined.
Okay, so that's the consequence. That's something the applicant might be declined if any of these legs aren't strong enough.
Exactly.
So will it ever affect the interest rate or the amount of time you can pay back, the amortization? Or is it just a decline or not decline?
If the situation that you can't get it approved in the A world, then it might be a situation where you have to take it to the B world because they don't have the strongest credit, because they may not have the best down payment. I might have to jump it to the alternative world, which then means, yes, you would be paying a higher interest rate. It's not a big difference. It's probably about a difference of 1 to 2% in interest rate, but it is a difference.
To a lender, what's the most ideal applicant?
The most ideal applicant to a lender is that professional who is salaried, makes a salaried income. They have the down payment from their own resources. They have excellent credit. Yeah. In that situation, if all of those sides of it are very strong, the applicant can buy an acreage without a problem, could buy a townhouse without a problem, because the property is not going to be that much of an issue.
Okay, just because the person has a record of being able to pay on time and have a very stable income.
Absolutely. Okay. Yeah. And then the other part of the down payment is using borrowed funds. So you can use borrowed funds for a down payment. That, of course, is only for people who are extremely strong with their credit and income, and there's no exceptions on those side of things.
So when you say borrow funds, is it like a line of credit?
Yes, you can use a line of credit, you can use a credit card, you can borrow it from a loan. That's another source of it.
I see.
Get a loan from a bank in order to have your down payment.
So in this case, there's a possibility that the property could be 100% financed.
Absolutely.
Okay. There are lenders out there who do that then, A lenders?
Yes.
Okay. Can you give us an example of something that you've done similar to 100% financing?
There was recently, I had a client go and get a personal loan from a bank.
Okay.
And as soon as I know the payments on that loan, we can use that. We just have to factor the payments into the debt service ratio as well.
Okay. Those people who doesn't know what a debt service ratio, can you explain that?
Debt service ratio is the ratio of the amount of debt to your income. So you would take the monthly payments on each of your required debts, meaning what is on your credit bureau, and you're not talking about any utility payments or cell phone payments or insurance payments.
So it's more like mortgage, if there is any, vehicle, credit card, line of credit.
Exactly.
Am I missing anything?
Nope, that covers
them. So those are your expenses, and then the income would just be the salary, if there is any, or commission, and then any rental, if there is any, right? Is there any other sources that I might be missing?
No, I believe you've covered it all.
Okay, so you take all that income and you compare it to all the expenses that the person had, and that's how you get your debt service ratio.
Yes.
So when you have a debt service ratio, what number is good?
You want to have 40% or less is ideal. You are allowed to go up to 42 and sometimes even 44, but you don't want to necessarily be pushing the guidelines there. With the GDS, the gross debt service, you're looking at the amount of income that is utilized in your annual income that goes towards your property. So what they take into account there is the mortgage payment on the property taxes, and the heating cost on the house. So
the heating cost.
And the lenders will generally use about, and this is an average, $100 a month for heating cost.
And heating is just the utilities then?
Yes.
Okay.
Heating of the house. That's
so
the only
not even
utility.
Water or electricity, just heat.
Just heat.
Okay.
And so you take those three, the monthly installments on the mortgage, the property tax, and then $100 for heat, and give that ratio with your income, and that needs to be at 32%. So there's two different ratios we look at in the mortgage broker world.